the banks are not the bad guys that we all think they are. The banks actually are a business that makes the lousiest kind of returns compared to other businesses. Okay, the bank got $100 billion. They only make 2 to 3% of everything. Whereas any other business like Google, every year make how many billion? Sell car, make how many billion? Sell oil, make how many billion, right?
I think we have some questions that is being thrown by the so-called attendees today. Why not, Brandon, do share some of the questions here with David so that he could uncover these burning questions as well.
Hi. Okay, so one of the questions is that, is there any strategy you can deploy between the fixed and floating rate at this, in this current rising interest rate environment?
Okay, so something that I learned from KS, how to explain this, right? You know, KS always talk about exit strategy. Whatever you buy today, you must plan for your next step. Because if it's a forever home, there's still a planning. If it's not a forever home, you have a planning. If you are just husband and wife with one kid, maybe you got 3 kids in the future, you want a big house, there's always planning. The same thing for interest rates, right? So now, as I mentioned, as interest rates rise, example, okay, if today SORA is 2% and fixed rate is 2.4%, floating rate is lower than fixed rate, right? So SORA plus what? SORA has to be plus lesser than 0.4. If not, if SORA is 2 and 2 plus 0.5 is higher than 2.4, the bank cannot sell SORA. So now you know when interest rates rise, the spread, the plus portion of the floating rate will drop. So today you will take fixed deposit link rate for BUC or maybe a fixed rate for new development, for resale. And you lock in at the high rate, never mind. Because what you want is to lower your variance, lower your risk. 2 years later, when the lock-in is over, that will probably be the highest interest rate time. You see the graphs are 06 highest, 07 highest, 08 start dropping. 2 years, right? At the highest point, your fixed rate 2.25, you jump into SORA plus 0.2, plus 0.3. That's the strategy for 2 years' time. So whatever you have today is up to you. But the strategy is you don't take 3 years fix, 4 years fix, that kind, because you want to get out at the highest point to go into the SORA rate and take the lower spread. Yeah.
Okay, that's very insightful. And we just got another question. So one of our attendees mentioned that he or she has 30%, less than 30% of the mortgage left. So does it make sense to actually fully pay up right now, or actually to refinance it? And she's actually on a 3-month SIBOR.
Okay, so it depends. Because 30% of your mortgage left really depends. Is it 30% of a 1 million house, 30% of a 2 million house? The absolute number makes a difference, okay? If it is, firstly, if you have the cash to pay up, I mean, you are suggesting that, right? You have 2 options. Pay up because interest rates are rising, or take that cash and find somewhere, I don't know where. I used to be a banker, now I'm not there for 7 years. I don't want to suggest, okay? Take that cash and make sure it grows more than the mortgage interest you're paying. That's how you do your own risk analysis, right? If I earn 4% but my interest only 3%, then I don't pay up lah. I earn 4% better, right? If I earn 10%, then even no-brainer there, right? So that would be how you decide. Then if you want to say refinance or not, okay, firstly, 3 months SIBOR, please refinance. Because unless you took the loan 3 years ago during the 1920 high, your spread should be more than plus 0.5. SIBOR plus 0.5, SIBOR like SORA will be 2% by January. You'll be paying 2.5 and above. Today, I can get you 2.4 fixed. You lower your variance, same story, get out after 2 years, change back to SORA. SORA, SIBOR similar, that's why I'm using the crosswords easily. But then again, if your loan is lower than 500K, if your loan is more than 500K for a private or more than 250K for HDB, the new bank, when you refinance, pays most of your cost for you. So if your loan is smaller, then you decide whether you can use that money to grow. If not, then you pay off law. And if you can use the money to grow, you must have other investment vehicles. Now, as KS has shown, something that he's shown, you're supposed to infer from all his graphs, right? Typically, capital gains, even in good times, bad times, normal times, is 2, 3, 4% one every year. Why? We said, inflation is 2, 3, 4%. Why? So even if you take that money, let's say your name okay, then your husband or wife, your spouse, you buy under your spouse name, he or she got no property, you will also make 2, 3, 4%. And that 2, 3, 4% will be better than whatever mortgage interest you're paying. So your money can be used to buy bonds, shares, equity, cryptocurrency, property. In a recession, take the safest thing, which is not Bitcoin or Ethereum. Okay, yeah.
Okay, so one of the very burning questions for many of the attendees is that why, when I buy a BUC, right, I cannot use fixed rates at this point in time?
Okay, so why? Typically, the question is why BUC got no fixed rates? Why? Wait some more. Why? Okay, the reason is this. We always try to, okay, how do we be better people? You try to empathize. Empathize means I try to put myself in your shoes, your budget, your finance, your lifestyle, everything. But it also has to cross-reference, right? My partner is not just you, for the consumer. It's not just KS, the housing agent. It's the bank as well. So I empathize with the bank. So why does the bank don't give you fixed rate? Okay, now, the bank doesn't make money for your whole loan. That is the bank is a money-making vehicle. In fact, if you think about it, right, the banks are not the bad guys that we all think they are. The banks actually are a business that makes the lousiest kind of returns compared to other businesses. Okay, the bank got $100 billion. They only make 2 to 3% of everything. Whereas any other business like Google, every year make how many billion, sell car make how many billion, sell oil make how many billion, right? The percentage of ROI for banks business is really the crappiest in the world, okay? So it's very stable. So the banks, right, need stability. If I give you a fixed rate for a loan amount, which I have to reserve for you, okay, I reserve 1 million for you, but the first year only give you 200K. Only on the fourth year, I give you the full 1 million. And I have to reserve for you because that's what the law says. You have to put it aside. I cannot use that money to grow. Then if I give you a fixed rate of 1% 4 months ago, I confirm lose money the next 4 years. So the bank don't dare to give fixed rate for that reason. The cost of funds is floating for the bank because the bank money is also floating because it's not fully dispersed to you. Therefore, the bank also have to give you floating rate only. Not the best explanation, I think, but it's too micro explanations, a bit too heavy for tonight.
Okay, good explanation. Okay, so I have this really long question, so just stay with me. Okay, for those who have taken a BUC mortgage based on a 1 month SIBOR with a 0.1% spread, should he then reconsider refinance it to 3 months SORA, and if the SORA interest rate increases to 2% next year?
Okay. So anything, that's why I said just now, the spread 0.5. I believe 0.5 is the fair number. Anything below that, right, is a dilemma. I literally sigh when I hear customer. There is no plus 0.1 for everyone. The best rate at that point of time was plus 0.1, plus 0.2, plus 0.3, and then plus 0.4 thereafter. But when you are in that rate you give me today, should I refinance or not? I sigh. You are in 50-50 territory, sir, man. This one, I advise you, I don't even earn money on because my thing is, I don't think you should refi, but because you're in SIBOR, by now, no banks are selling SIBOR, and MAS will remove SIBOR. That means SIBOR is no more, does not exist anymore by the end of 2024. If you are still in SIBOR at that point of time, the bank that you're with reserves the rights to give you any rubbish rate they want, and most probably it will be the board rate, which you don't take, okay? So what you actually want to stay in, if your spread is so low, stay with SIBOR law, no choice. Stay for the next 2 years, then again at the same timing when you can hop onto SORA at the best spread. Nobody knows the lowest part of the market again. So if you expect, okay, 0.5 can already, 0.4 can already, please just jump. Because if you see the graph KS show also the market down and up, there's only that small margin of 1 quarter where it's the lowest. You wait, you miss it, you go back up, then maybe it will drop again. You wait, suddenly go back up already in 1 year. That margin is 1 quarter is very hard to time the trigger, okay? So expect maybe SORA plus 0.3 will be brilliant. Then you call me every day, and then I'll message you every month. Hey, what's the plus 0.3? Not yet. Then when it's 0.3, refinance, reprice at that point of time. But it's a dilemma because you can take it and keep your SIBOR plus 0.1 still, but you can also change to a fixed rate because SIBOR past 10 years high, 1.96%. SIBOR past 20 years high, 3.6%. So there's that fear. I cannot tell the future. I don't know how the Fed rates will go until. I also cannot tell the future. Singapore is not US. US raised interest rates because of a lot of other reasons. The main reason is they print money, right? So now they got high inflation problem. If Mr. Lee Hsien Loong and MAS says that it doesn't make sense for Singapore, recession interest rates should fall, right? And recession really happens, MAS may actually say, don't peg our mortgage rates to US. We never know the future. So that risk is very scary. SIBOR can go to 3.6, but we also don't know what MAS will react, because MAS cannot kill our citizens to satisfy US also. So it's a part where we don't know lah. Like just now I also say, I don't like that the government gave concessions on the loans. But at the same time, if I am a consumer, I want the concessions. But then from the macroeconomics, I don't think it's correct. Again, there's no way to please everybody, right? As a consumer at that point of time, if I was having trouble, I welcome the concessions, right? So there's no way to please everybody. And I think, the brilliant minds that we have in the government actually will make the best decision for the majority. But yes, it's a dilemma. In summary, don't know whether to keep or not. Even I tell the customer, I also don't know whether to keep or not. I base it on your risk level, your risk appetite. Then I'll tell them my opinion. I am risk level very low one. I will take fixed. But up to you lah.
So it really depends on your risk appetite.